All right. Good morning, everybody. I think I was just talking for 8 minutes and I just realized we weren't live. Uh, there you go. Let me know if you guys can hear me okay quickly, if you don't mind. I'm sorry. I'm obviously way off here in terms of timing. Um, yeah. Sorry for being late. I was just talking to myself. I didn't hit the go live button. That's what happens when you don't pay attention. But we're live now, hopefully. If you guys could just give me a quick yes into the chat box, please let me know. And again, apologies for being late. We're going to have to keep this to about 10 minutes here this morning, but it's enough to go over everything here. Just give us a quick yes if you can see me and you can hear this, and you can hear me as well. Yeah, perfect. Thank you. And again, sorry for that. I didn't hit the go live button. So anyway, I do have something new though, something cool, which is I'm able to now flip back and forth between two cameras. So that's going. Anyway, what I was talking to apparently to myself about before is essentially this week that we are likely going to continue to see the S&P basically hold up, right? So so I think that's important. And the average true range, which is, again, I was talking to myself before, the average true range for the equity market is likely going to be contained. Where the hell is my thing here? Here. Okay, so the average true range for the S&P, you can see, if you look at it down here, it's essentially been dropping steadily since August, and I don't think that's going to change. That's going to change. I think we're going to be quite contained. Again, we talked about this late last week to our clients. We said 600 is very likely in the cards this week, and indeed we reached 600 on the SPY yesterday. Again, I still think 620 is possible this year, and then we'll have to kind of see. Again, there's a lot of news happening every day. But most importantly, what I'd like to do is I'd like to look at gold. And this is, what we saw yesterday, the announcement of Scott Bessent as the Treasury Secretary is exactly the type of news that is going to be why I think we're going to have such a big trading year next year. And why I think we're going to have a crazy ton of opportunity. Again, I mean trading, not blindly buying dips and that kind of stuff. That's not trading. That's, for the most part, blindly, kind of gambling. I think people have forgotten what trading means. So I think we're going to see a lot of that. So next year. But it's already happening. And the move in gold yesterday was important. We actually made some changes this morning in our portfolios for Inner Circle and ETF Salo Pro. And to keep it sort of short and a big picture summary, we've been gold all year. It remains my longest position. I'm not selling my gold. Personally, what I'm going to do is I'm going to short futures once momentum trains to the downside. But from a sort of portfolio perspective, we have now actually officially removed gold from some of the portfolios. Again, if you're an Inner Circle member or ETF Salad Pro member, you have probably already received those emails this morning. If you haven't, they'll be going out here shortly. But why? So first of all, obviously gold had a big move this year. It's still holding up in terms of performance with stocks. If I share with you the performance this year, let me quickly share this with you here. So this is the performance of gold and stocks, and you can see they're basically in line. They're still holding up together. But as I think about one of the major tailwinds for gold being the U.S.'s irresponsibility on the fiscal side, if Scott Bessent can achieve his target, and again, this is obviously a big question mark still, but it's enough to maybe spook the market a little bit, of 3% deficit of GDP. That's half of what it is. It's less than half than what it is right now. We're currently running about 6.7% deficit GDP. And if you can lower that down to 3%, that takes some tailwinds for gold out. Doesn't mean that gold necessarily is short. Again, I am going to remain gold personally long, but I might be trading futures or hedging futures against it. That's just my personal strategy in my long-term portfolios. I don't want to get rid of something as core as gold, but just as an FYI. So that's a big deal, and also volatility has increased. If you look at gold and you look at it basically, year to date until somewhere around mid-October, the volatility remained roughly the same, and then it started to increase. We had a big blow off top towards 260 on the GLD, and gold miners and silver, although they played a little bit of catch up, they never really caught up in a meaningful way, which is also, to me, was quite surprising to see. And so we're out of those positions as well. But along with that, yesterday came this huge move in the bond market, and I don't think the bond market is, if I could type this in properly, I don't think the bond market is done going higher in yields, but yesterday was a big shock. And again, this is, I think, exactly the kind of stuff that we can expect to see going forward, because we are going to see a lot of change. Whether one agrees with the changes or not is from a market practitioner's perspective almost it doesn't matter, because all we're trying to do is make money. And so gold, again, there's something that's changed there. I'd be careful with blindly adding to gold. The time to buy gold was a long time ago. If you have the Market Rover, and if you don't, please get it. I mean, you just need it. Gold clearly became a buy back in January of this year, the GLD, and then it rallied as much as 37%. It's now still up 30. So, these big trend changes, and the trend hasn't changed, by the way, right? It's just becoming more choppy, which is enough for me to kind of take a step out. Last and really important point I would like to bring up is this chart. This is straight from the Bloomberg terminal, and this is basically just a ratio chart. And what we're showing here is we're showing the NASDAQ 100 versus the Russell 2000. The Russell 2000 is a really bad small cap index, because a lot of companies in the Russell 2000 are total shit. Excuse my language. But you can see that rotation, and we've talked about this now for a long time, certainly all year, that at some point we're going to start to see this rotation, right? And so the NASDAQ is underperforming, at least for now, right? That can always change again, of course. I don't know, what the future holds every single day, obviously. But just be aware of this. So if I'm going to quickly show you this chart here in a bit more, a larger format. So I'm going to go QQQ divided by IWM. And if I just make this very simple, a simple line chart, those people that like to draw lines and call that analysis, on its own, then, that should probably, get, again, even my 6-year-old can draw better lines than I can. Those are lower highs. It doesn't mean that tech is trash, but it could underperform. And most people are not positioned for that, particularly the higher for longer investment theme. And by the way, the higher for longer investment thesis, that's not a static hold. Okay, so if you think you can allocate to the higher for longer investment thesis and all you can do is just buy one ETF and call that a day, good luck with that. It's not going to work, because it needs to be proactively managed. But this is important. So if you look at, for example, NVIDIA, and I know I'm going to get some hate mail on this. So NVIDIA, since earnings, and everyone under the sun has been saying that the stock's going to be at all-time highs right after earnings. Well, since earnings, the stock is now down for the most part about, let's call it 6 or 7%. That's nothing. The stock can drop 30 or 40% and still be a very strong chart and a good company. But it's not, right? So and this plays into this higher for longer inflation theme. Again, it's the QQQ divided by IWM. That's the chart I want to show you. And again, this rotation could continue for a long period of time. It's not going to work every single day, every single week, but it's likely going to continue to be a theme. And this is something we've been talking about the clients for months and months now, that, it's nothing new. It's, I see what institutional investors do. And I know they have been they have been rotating out of these tech stocks, not shorting them, but taking down their exposure. And this is the end result of that. So if you're wondering when did tech peak versus, let's say, small caps, that's actually happened in early July, and it hasn't recovered. It's hasn't gotten a whole lot worse since it was in July. It's about the same, but it hasn't gotten better. So just food for thought. Again, I'm not bearish tech, but I do think tech is going to underperform for a while, and it's going to cause a lot of problems in portfolios. Anyway, since we were late, I apologize for that. I didn't hit the go live button. I now have to jump on over to the Inner Circle member session. We're going to talk a whole lot more about gold. I want to talk about a couple of trades that we're in as well. Please make sure you join us over there if you're an Inner Circle member. If you're not an Inner Circle member, reach out to Joel. He can help you with that. Please give it a thumbs up, like, subscribe to the channel. That allows you to be alerted in real time when we do these live pop-up sessions. We're going to do a ton more of these going forward. We're really just getting started here. And we'll be back tomorrow, one last time this week. Then we're going to go into Thanksgiving. We'll try to refresh a little bit before we start off December on Monday. Any questions, always, please let us know, and have a great trading day. And again, Inner Circle members, we'll see you over in the chat room in the member session in literally like 1 minute. So we'll see you there.